I think the bond yields in India will be sharply lower in next 1-2 years, perhaps even lower than what we saw in COVID. Gold could be a small allocation. Again, it likes the fact that real yields in US will come down. So therefore, it's done really well already. So to that extent, you should be cautious there. Equity is a space, where there's a lot of momentum. The margins sort of remains high, both in US and India, but the revenue sort of has started to come off. Even EBITDA and PAT sort of in India, last quarter numbers were not that great. So you ought to be cautious, that remains my view. To ensure that an investor who put in money in 2019, over 10 years, gets the same return as he would have earned in any point in time on average in last 30-40 years, because last 5 years returns have been so good and stellar, the next 5 year has to be muted to get to the median. So because you've earned 16-17% in last 5 years, you will have to end up earning 7-8%, right? So that the average is still 11% or 12%. But there is a little bit of a euphoria building out there. It's very, very difficult, as you know, to be excited about equity for what the valuations are today. In a sense, for a very long investors, incrementally, if the action is going to be binary, that this or that, then it would still be, overweight, that you would think that equity is the right place to go, if you have no other decision to make. But if you have a more sophisticated investors and you can do underweight, overweight, then you will begin to now, even at long-term level, you'll take a call that no, right now let me be underweight equity because valuations are expensive. For short to medium term, which is 1 year, 3 year, I would certainly say overweight bonds or significantly overweight bonds. And 3 to 4 year, 5 year, I would say that, credit is a decent strategy which will give you as much risk premium as equity, but without the volatility that equity actually comes embedded with.